Welcome back. You're watching The Money Show, and it's time to get our viewers on board because there are a plethora of funds available in the market to invest your hard-earned money in. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? Today I have with me Nisreen Mamaji, CFP, Moneyworks Financial Services. Also, do not forget to send across your portfolio queries on our WhatsApp number, which is 8657974571. You can also email us your questions on themoneyshow@etnow.tv. Nisreen, good evening and welcome to the show. And let's begin with our viewer queries. I have Dharunesh on the phone line with me. Dharunesh, hi, good evening.
Hello.
Hi, you're calling from?
I'm calling from Bengaluru.
Bengaluru. All right. How can we help you?
So I have a specific question. So
Sure.
we have something called as BSC Enhanced Value Fund, and we also have a lot of related funds, right? So I already have my portfolio quite set up with your help. So I just wanted to know, what is this Enhanced Value Fund, or is it like better to replace with that Nifty 50 Value 20 related
Sure.
fund? So I just wanted to know that.
Sure. Apart from this, Dharunesh, you do have a mutual fund portfolio with you.
Correct, yeah.
All right, so let's get you the details of this fund. So, Nisreen, what is this fund all about? Motilal Oswal S&P BSE Enhanced Value Fund. Let's just start with this.
Yeah, so basically, this is the value fund, which comprises the top 30 companies from the S&P BSE large mid cap index based on the value score, which is a broader index, compared to the Nifty 50, which is already there on his portfolio. The Nifty 50 Value 20 tracks about 20 stocks, while the Enhanced Value tracks about 30 stocks. Now, basically, the Enhanced Value, is a very volatile fund, and compared to it's based on equal weighted average of the price to book, price to value, and price to sales scores. So the problem is that it is highly volatile. And the returns, though, have been also excessive compared to the Nifty 50 Value 20. The last 1 year returns for the Enhanced Dynamic Fund has been nearly 89%. And the Nifty 50 Value 20 has returned about 34.5%. So that is a call that the investor has to take based on the higher volatility, because it has actually lagged, compared to a couple of indexes. Which is which index is it like with? Okay, so what I'd like to say is that both these funds are highly volatile. An investor who seeks some kind of a asset allocation in a value fund would be wise to take either of these. One of them has only got 20 stocks, and the other has got 30 stocks, which is the Enhanced Value Fund. So I think, if you're able to take the higher risk value with the volatility, then you are quite safely placed in the Enhanced. Otherwise, the current fund that you are in, which is the Nifty 50 Value 20, you can continue in that as well.
Dharunesh, do you want to tell us about your risk profile?
Nothing much to the risk profile. I would say that I have much of smart beta funds available, like
Sure.
Nifty 50 Value 20 is one of it, and Nifty Alpha Low Volatility is second one. The third one goes to UTI Momentum 200 Index, and I
Okay.
have an Quant.
So you can digest volatility is what I'm able to understand. Is that right?
Yes, that's right.
Okay, so I think the parameter based on which you need to decide, it's pretty clear. Anything else you want to ask, Nisreen?
So basically, the data shows that the S&P BSE Enhanced Value TRI has lagged both the S&P BSE Large Mid Cap TRI and the Nifty 50 TRI on the 5 and 10 year returns over the last 15 years. So that's a call that then you have to take, because it has been lagging both these TRIs.
So, sure. So irrespective of what risk appetite he has, what will be your recommendation looking at this case, Nisreen?
So I think that if he can withstand the volatility, then obviously the Enhanced Value has 30 stocks and has shown also the last 1 year returns to be high. So if you're okay with the volatility, even though it has lagged the large cap and the other Nifty 50 index, that is, secondary. You seem to be very comfortable in working with smart beta products. So I think that you can easily replace the enhanced value fund, the Motilal Oswal, with the current investment that you have in Nifty 50 value 20. That would be my recommendation.
Clear-cut recommendation coming up from Nisreen. All the best, Anish. We move on, and an email question from Mr. B. Shri Harikant, and he says that he is looking to build corpus for his early retirement at 2035, and current age is 32. He started investment somewhere around 2020, and right now he's investing 65% of his net salary. SIP is 30,000 and other is 20,000 per month. He is investing in good businesses for long term on quarterly basis. So total 55,000 per month. That's what is going out. Funds in his portfolio are PPFS Flexi Cap. He's got Kotak Emerging Equity, Axis Small Cap, Canara Robeco Small Cap, and he wants to add one more fund and also step up his investment amount to 5,000 more, and return expectation from 12 to 15 years. That's the time horizon that he's looking. So return expectation is 12 to 15% in long term is what he's saying, and he's a long term investor, and he also can handle high volatility in his investments.
Sure. So he's selected already very good funds.
Right.
The Parag Parikh Flexi Cap Fund, which is currently investing about 15,000. So we would recommend that he bring that down to 10,000. Kotak Emerging Equity, you continue with 5,000 rupees. Axis Small Cap, you continue with 5,000 rupees. Canara Robeco Small Cap, you continue with 5,000 rupees. The additional fund that we propose is Franklin India Opportunities Fund, which is a sectoral thematic fund which you can invest to for about 10,000 rupees. So your entire asset allocation will be about 30% in sectoral or dynamic. Flexi cap also about 28%, large and mid 14%, and small cap about 30%. So that's going to be your typical asset allocation. And so that's, the extra fund that we have asked you to invest is Franklin India Opportunities Fund to the extent of 10,000 rupees.
All right. Any specific reason why you selected these funds for him, Nisreen? Like, what's your selection criteria?
Some were already selected. He's already got Parag Parikh Flexi,
he's got that.
Emerging Equity, Axis Small Cap, and Canara Robeco Small Cap. So those are already doing well. We don't see any reason to, change his portfolio. He can continue in that. Only thing is a small asset allocation has been changed. Parag Parikh Flexi Cap has been reduced by 5,000, and Franklin India Opportunities we've increased to 10,000, so that there's a total SIP of 35,000 rupees, which he proposes to do. And with this, his expected expected returns of 12 to 15% over the long terms, we expect that to be met as well. So that is why we don't want to add any more funds. His current funds only we will continue over this period of time.
Let's move on to other email query from Abhilash, and he says that he wants to invest 10 lakhs lump sum in stocks or mutual funds, and how should he go about it? So Abhilash, on the Money Show, we'll be talking about mutual funds because throughout the day on ET Now, you get a lot of recommendations for stock investments. So maybe we can also have your question answered on those part of the shows. But then on the Money Show, 10 lakh rupees, Nisreen, in mutual funds. We don't know the time horizon, but assuming that he has a time frame of 5 and more years, how should he be diversifying 10 lakhs?
So typically, for a retail investor, we definitely recommend mutual funds rather than direct stocks. Some of the reasons are diversification. In a mutual fund, you will, in say a diversified large cap fund, you will get at least 70 to 80 stocks. But in a stock, if you buy only direct equity, you'll probably land up buying 4 to 5 stocks. So the diversification itself is a risk mitigation tool. In case one company doesn't perform or 2 companies don't perform, the rest of the portfolio will still perform. Thereby, you will get an expected average rate of return. So because of the diversification, we would expect that, suggest that you invest in mutual funds. Another situation is another reason or advantage is that generally in the risk and return basis, generally mutual funds are considered less risky rather than directly investing in stocks, not only because of the diversification, but because of over a period of time, it will give you higher stability. So stocks will be tending to be high risk, high return. But if by mistake selected a stock which doesn't return you, then your entire investment will be in the red. But mostly in mutual funds, we feel a certain average return you can get because of the diversification, advantage. One other thing is, time and expertise. In mutual funds, once you've handed it over to a professional team of managers, which consists of researchers, analysts, and an entire network of people, you can sit back relaxed. But with stocks, you have to constantly keep monitoring, you have to analyze yourself. So you will have to spend a lot of time in this research. If you're able to do that, that's secondary. But most retail investors, once they've invested, they will forget about it. And they expect, that the portfolio performs on its own. Therefore, in the term of time, constraint, it will be better that a mutual fund entire team looks after the portfolio. Where liquidity is concerned, a mutual fund can be redeemed at any point of time because, the fund house will have to buy over your units at the NAV of that particular date that you seek redemption. But in stocks, that may not be the case. If there is no buyer, then you cannot easily liquidate or surrender. So the control lies more with you in mutual funds. As far as costs are concerned, there is a certain cap that SEBI will keep on mutual funds. There will be obviously an expense in terms of, management fees. And in stocks, you will also have certain kind of costs, which are, the broker fees, etc. So both of them will have costs. Mutual funds will also have a management charge, as well as stocks will have a certain cost. Typically, you might find that stocks the cost might be lower, but the risk will be higher. So that's why, I would suggest that mutual funds to the retail investor gives you a whole basket of advantages, as well as, highly regulated by SEBI. So you should be considering mutual funds more strongly than investing in direct equity.
All right, Nasreen, we do have many questions for you, but then the time is up for today. So thank you so much for taking time out and helping our viewers with their financial portfolio. On that note, it's a sign off from me as well on the Money Show today. But you keep on sending your queries to us. And how would you do that? You can WhatsApp your questions on our WhatsApp number, and our email ID you should note down, the moneyshow@etnow.tv, and 865-797-4571 is the WhatsApp number where you can send across your questions. Thank you so much for watching. Goodbye.